Welcome to Subramani. Please hit the bell icon. Please subscribe if you have not already subscribed. I'm going to talk to you about how to invest during a war, and I'm going to talk about two types of wars. One is a real war, as we see happening in, say, Hamas or Indo-Pak. Right now, what's happening, Operation Sindoor, right? and one is when you're not impacted, like you're an observer. If you're in US, maybe you're fighting a war, but you're not getting impacted. You have no body bags coming, nothing, because some other people are fighting, you're just supplying arms. An Ukrainian falls, a Russian falls, but it is not the American who falls. So yes, there is the Ukrainian war, there is the Hamas war, and now India trying to kill the infrastructure of terrorists built on Pakistani soil, right? So the three major points of conflict in the world today. So, do we expect a quick short war in the Indo-Pak thing? Will Pak respond? I'm not getting into all that. That is politics. But what is likely to happen if it's a slightly more prolonged war is the inflation. Inflation will be higher because goods movements will be impacted. It may not move so fast, it may not move so smoothly, and some parts of the country may be closed, maybe in a blackout, right? So in those cases, sales might go down. So some of that will be impacted, and very good chance that there will be inflation, and inflation will be slightly higher than what the RBI wants, which means the interest rates could remain higher, and EPS could be impacted because of higher inflation, right? So both these things could happen. What should you really do? I mean, you have to really be prepared for a slightly higher inflation. If you think inflation in India is going to be 5%, I think you should be prepared for 6.5%. That's about all. Nothing else is going to happen. But because of that, the people's expectation from equity markets will go down. So people will say, let me just exit some stocks and let me remain in cash. I will enter the market after the market falls and things like that. So that is one possibility. The other possibility is people saying, oh, it's a time for me to buy. Markets are down, so it's a fantastic opportunity. Market is 400 points down, 2000 points down, whatever, right? Whether you look at the Nifty or look at the Sensex. So those things could happen. So people could anticipate and buy or anticipate and sell. Both will happen. So assuming both the forces are equal, market may not go anywhere, but chances are market will be a little lower. So you have to be worried that will you be able to preserve your portfolio. This is not a time when you're looking for growth. This is the time when you're going to look for preservation of your portfolio. So is that possible? Yes, it is possible. Will interest rates remain where they are? Perhaps yes. Will it go down? Perhaps yes, perhaps no. It's very difficult to say, because if government sees inflation going up, they're not going to cut interest rates. But if inflation goes down, you could see an interest rate cut, which could mean the gilt that you're currently holding in your portfolio will appreciate. But it is also possible that the RBI is told, don't do anything with the interest rates, etc., till the war is over, and the war is going to take 15 days, so 1 month, whatever. So that kind of a period, you will have uncertainty. Is it going to really impact the long-term shareholder? Does he have to do anything? I don't think he needs to do anything. But yes, if he thinks some shares are worth selling because of the war-like situation, or because he needs money, and I have seen people buying up the subscribing to the defense portfolios, buying shares like Hindustan Aeronautics, saying, oh, they're doing a great job. For all that great job, etc., to translate to EPS is going to take time. So this might be an opportunity for you to get out. But for somebody who does not have an exposure to defense, it might be a great time to be getting in, because you have proved that your quality of ammunition is good. In a warlike situation, there can't be a better sales pitch. So you might get a lot of foreign orders. All those things could happen. So yes, some of the defense stocks could do well. Some of those stocks which are subject to inflation, right? So those may not do well. Housing sales may not be good. But I don't think, I have not met Indians saying, how should we invest now that there is a war? I don't think Indians are looking at this as war. They're just looking at India going and breaking the terror infrastructure that Pakistan has allowed to be built in its own its own soil. So other than inflation, I'm not too much worried about what you should do during times of war, and we are perhaps not going to be too much in times of war, right? So maybe 15 days, and by the time we'll look back and say, okay, that's it, we have destroyed their terror infrastructure, we have nothing more to do, and we might withdraw. But then if Pakistan attacks India, then it could again be a prolonged war. I'm not getting into the time of the war, I'm not getting into how long it is going to last, etc., etc. Those things don't really matter from a investing point of view, because after some time people just get used to it, like how we thought it would be a 3-week war in Ukraine, and it turned out to be a 3-year war already and counting, right? So that is one thing. Second is, if you are with a gilt portfolio, if you're in a gilt portfolio, may not be leverage, but in a huge gilt portfolio, saying the RBI will cut rates or the Fed will cut rates, that may not happen so much in India, because the government might say, just wait, let the war be over, and after that we'll attend to you. So for some time that may not work. Second, do not assume that the former winners will be the future winners. In fact, if I look at the American market performance, the Magnificent Seven have just performed too well over a long period of time. Also, if you take a slightly longer period, simply because the rise was so steep, right? So the CAGR looks very good, but the chances are they won't be the winners in the next round. So if you are excessively tech oriented, be careful about what you are doing, because I think you should get more into a general portfolio. But definitely you have to worry about the whole portfolio and saying, do I look at some of the stocks and get rid of it? So I also think you should consider mutual funds growth option, because you can always book capital gains on retirement. So something like that you should do, and this got nothing to do with the tariff war or the war that is happening in Indo-Pak, but you should consider creating more money through ETFs and mutual funds. But having said that, I also think it's a great time to be buying individual stocks. So maybe alternative assets, but definitely buying individual stocks. If you think Hindustan Aeronautics is good, buy it. Don't keep on waiting, saying I hope it will come down and things like that. If you think Yes Bank is worth buying, buy it. Because I think apart from mutual funds and ULIPs and all collective investments, this is, I think, a good time to look at alternative investments if you need it at all. I personally don't, and or look at direct equity investing. Sounds a little contrarian, but it makes sense to look at some individual stocks and say, I think this stock is going to benefit or this stock is going to lose, right? So I think it also makes sense to maintain a slightly higher cash reserve. If you keep 6 months expenses, better to keep maybe 8 months expenses, because you don't know, with uncertainty, it's like a marriage happening in your house. Keeping some extra money in the savings bank account doesn't hurt till the marriage is over. So similarly, keep a little more money, a little more cash with you, which might be useful in case there is a prolonged war, right? Do review your financial long range plan with your financial planner, saying, look, this is happening, this is a tariff war happening, this is a war happening in the Indo-Pak border, this is happening in Hamas. So should I re-look at my portfolio? I'm already 55 years of age, I'm already 72 years of age, I'm already XYZ, right? So look at that, look at your longer range planning. I think looking at individual stocks makes sense, though I'm contradicting myself. Normally I suggest mutual funds. So yeah, maybe I'm also, between buy, sell and confused. I'm a little on the third stage. Thank you.